Hello guys, welcome to the fourth video related to the variance analysis. In the first video, we talked about how to prepare the static budget and flexible budget. In the second video, we talked about how to calculate the variance for direct material cost. In the third video, we learned how to calculate the variance for direct labor cost. So this is the fourth video. In this video we are going to look at the variance for variable overhead. So firstly, let me give you a quick overview of the production overhead. So what are the production overheads? Actually, the production overhead consists of all cost of manufacturing that are not direct material or direct labor. So there are three components of the manufacturing overheads. So first component is indirect material, second component is indirect labor, and the third component is the factory operating cost. Indirect materials is the tangible input to the production process that cannot be practicably be traced to the product. So for example, if you are stitching shirts, so use of thread is the indirect material. If you are manufacturing furniture, so maybe use of glue is the indirect material. And another example may be welding compound used to put together a piece of heavy equipment. Second, we have indirect labor. Indirect labor is the cost of human labor connected with the production process, but that cannot be practicably be traced to the product. So usually it includes what? It includes the wages of assembly line supervisors and janitorial staff. During the production you might have certain employees who are directly working on the manufacturing of the product, so that is classified as direct labor. But any staff, you can say the supervisors are above level, or janitorial staff like cleaners, maybe the maintenance workers, so they are classified as indirect labor. Then you have a factory operating cost. Factory operating cost, like maybe we are entering certain costs like utilities, real estate taxes, insurance of the factory plant and machinery, depreciation of the factory equipment, or the factory rent. So these all are called factory operating cost. And don't forget, these three are the components of manufacturing overheads. The factory overheads we can classify into further two categories. So overhead cost could be variable or it could be fixed overhead cost. So variable overhead cost include the indirect material, indirect labor, utilities like electricity consumption, and any depreciation expense under any method that ties depreciation to the level of output. The variable cost are those costs which will change with the level of activity. So these are the example. So fixed costs are those overhead costs which will not change with the level of activity. And the fixed overhead cost can include like such as real estate taxes, because it is fixed, insurance, it is fixed, rent, and depreciation expense under any method not related to the level of output. So this is what is called the fixed overhead cost. Practically, company should maintain two different accounts. So first account they should have for the variable overhead cost, and in the second account they should record the fixed overhead cost. Now the question is that because we are going to assume we are treating both costs separately, so how you will take the variable overhead cost to the product? So first we need to calculate the variable overhead application rate. So variable overhead application rate, we can also say it is the standard variable overhead application rate, which is always equal to estimated total amount of variable overhead. Like, because this rate usually we calculate at the start of the period, so that is why we need to estimate the total amount of the variable overhead, and we will divide it with the estimated total activity level. Now in the question you might be provided here, activity level could be machine hours, it could be labor hours, or any other base like maybe output. So if your work is machine intensive, like most of the work is done through the machine, so activity level you should use here machine hours. But if your work is labor intensive, like the most of the work is done through the labor, then you should divide here labor hours. But if you are not provided with the data of machine hours or labor hours for the variance purpose, so the third base which he will use to allocate the variable overhead cost to the product, that is output level, like units of production. In exam you might face two cases. The case number one, maybe the variable overhead will be absorbed based on machine hours or labor hours, and the case number two, maybe the variable overhead will be absorbed based on level of output. I'm gonna to explain first what to do if variable overhead are absorbed based on machine hours or labor hours. You can see here, if variable overhead are absorbed based on machine hours or labor hours, so how you will write the variable overhead in the product cost. So this is written, we will write this way. We will take like labor hours or machine hours, multiply by variable overhead rate for each labor hour or machine hour. So that is why your variance could arise due to changes in labor hours or machine hours, or maybe due to change in rate for each labor hour or machine hour. So this is what we are going to learn here. So look at here. So variable overhead flexible budget variance. Flexible budget is also called flexed budget under British study, but it is flexed budget under British studies is known as flexible budget under American studies. So the variance for the variable overhead flexible budget can be divided into two sections. The first section, the variance could arise due to change in price or the rate, which is also called spending variance. And the second, maybe the variance could arise due to changes in the quantity of hours, which is also called usage variance. It is also called efficiency variance. Case number one is if the variable overhead are applied based on labor hours or machine hours. So how you can drive the formula? So we have two alphabets. First is called A and second alphabet is the S. So we have to make three possible combination of these two alphabets to drive the formula. First combination is A time A, and second is A times S, and the third combination is S times S. First column represents hours and second column will represent the rate. For example, if you will look at here, so it is actual hours times actual rate. Second line is actual hours times standard rate, and the third line is standard hours times standard rate for variable overhead. So these three lines are written here. So you will take here actual labor hours times actual variable overhead rate per labor hour, and second line is actual labor hours times standard variable overhead rate per labor hour, and the third line is standard labor hours times standard variable overhead rate per labor hour. So if you are not provided with the actual labor hours, how you can calculate? So you will take actual level of output multiply by actual hours per unit. So same line you will paste it here because second line is also actual labor hours. But if you want to calculate the standard labor hours as per flexible budget under American studies or as per flexed budget under British studies, so how you will take, you need actual output level multiplied by standard hours per unit, which is also called budgeted hours per unit. If you will look at the first two lines here, you can see here there is no difference between hours, but there is a difference between rate here. So that is why if you will take the difference of first two line, so this will result in rate variance, which is also called spending variance. But if you will take the difference of last two lines, so which is actual labor hours times standard rate, and standard labor hours times standard rate. You can see here there is no difference between rate, but there is a difference between hours. So this is called efficiency variance, or it is also called usage variance or quantity variance. Now, if you will net off variable overhead spending variance plus minus variable overhead efficiency variance, so this will result in total variable overhead variance. But if you want to calculate directly total variable overhead variance, so what we can do, we can take the difference of the first line and the difference of the last line. You can see here, first line is actual hours and the third line is standard hours. It means there is a difference of hours are there. I mean to say efficiency variance is there. And if you will look at here, there is an actual variable overhead rate, and here we have a standard variable overhead rate. So it means rate variance is also there, which is called spending variance. So directly, if you will take the difference of first line and the third line, so you will get the total variable overhead variance. As just we learn now, if you will take the difference of first two line, this is called spending variance. So let's move to the more detail. So you can look at here, so variable overhead spending, which is also called rate variance. It is the difference between actual rate of the variable overhead and the standard rate. So this is really important. So favorable rate variance occurs when your actual rate is less than standard rate, and this could be the for reasons. Number one, maybe the first reason is economies of scale, increase in the order size of indirect material leading to the bulk discount on purchases. In when you achieve the economies of scale, your product cost will reduce. Why? Maybe you are buying the indirect material in the bulk quantity and you are getting discount. And second reason could be maybe due to decrease in the general price level of the indirect supplies. Maybe there is a deflation in the economy, and due to the deflation, maybe the prices has decreased. The third reason could be maybe the more efficient cost control. Maybe we are using energy efficient equipment. Due to that, our variable overhead cost is reducing. So these are the causes for favorable rate variance. Now you can see here, so you might also have unfavorable rate variance, and unfavorable rate variance occurs when your actual rate of the variable overhead is greater than the standard rate, and following could be the reason. Number one, maybe the rise in the national minimum wage rate. So of course, if the government will increase the minimum wage rate, so this will lead to a higher cost of indirect labor, and this will result in a higher actual rate than standard rate. Second reason for the unfavorable rate variance could be maybe due to increase in the general price level of indirect supplies. Maybe there is a inflation in the economy. Due to inflation, we are paying more for indirect supplies. And the third reason for unfavorable rate variance could be maybe we are using inefficient energy equipment, like those equipment which are not cost efficient. Okay, so that is why maybe we are consuming more electricity, and this will increase your actual rate. Now we are going to look at direct, I mean to say variable overhead efficiency variance. Where is a mistake? So we have a variable overhead efficiency variance. So you can see here, variable overhead efficiency variance is the difference between actual labor hours and the standard labor hours. The standard labor hours are those hours that should have been used for actual level of output. So the question is that how to calculate the actual labor hours. If you want to calculate the actual labor hours, you need actual output multiplied by actual hours per unit. And if you want to calculate the standard labor hours, as just we learned above, so we need actual output multiplied by standard hours per unit. Now your variable overhead efficiency variance, it could be favorable. Favorable variance will occur when actual labor hours are less than standard labor hours, and following could be the reason. Number first, maybe it means that employees are working efficiently, because we are absorbing here overhead based on labor hours. So your actual labor hours are less than standard. Maybe the first reason, maybe your employees are more efficient, they are more skilled, so that is why they are taking less time. Second, maybe it could be the effect of learning curve also. Maybe with the experience, they gain experience and their time to produce the next level of output is reducing. Third, maybe we hired more or high skilled labor, so this may adversely impact labor rate variance, don't forget. Fourth reason could be maybe the use of better quality raw material, which are easier to handle, that is why labor is taking less time. The fifth reason, maybe we have installed more efficient equipment, so which will result in more production level, so this could be the result. This could result in favorable efficiency variance. Now we have unfavorable efficiency variance. Unfavorable efficiency variance occurs when your actual labor hours are greater than standard labor hours. So the following could be the reason. First, it may be caused by using worker with less skill. Of course, if you are using a low skilled labor, so that they will take more time to produce the item, so this could result in unfavorable efficiency variance. Second reason may be we are using material with the low quality, which is not easy to handle, that is why labor need more time to produce the item, so this could be the reason for unfavorable efficiency variance. Third, maybe lower learning curve achieved during the period than anticipated in the standard, so this could also result in unfavorable efficiency variance. Here we have one important note. This can be tested in the question also. Please focus here. So here note is what? Because if you are absorbing variable overhead based on labor hours, okay, so it means we will use the same labor hours which we have already utilized in the direct labor variance. So this note is really important. If the labor efficiency variance is unfavorable, so the variable overhead efficiency variance should also be unfavorable, because it is based on the same number of labor hours, and vice versa. Of course, if the labor efficiency variance will be favorable, so your variable overhead efficiency variance should also be favorable. This is really important note. Now we are going to talk about case 2, what to do if you are absorbing the overhead based on units of output. So this is the second case. It's really important. In second case, what you will do, so first we have a first line is actual units of output multiply by actual variable overhead rate per unit of output. So this will give you, by the way, actual amount of the variable overhead. Sometimes straight away you will be provided with the actual amount of the variable overhead into the question. And second line, you will take actual units of output multiply by standard variable overhead rate per unit of output. By the way, this is also called flexible amount or flexed amount under British studies. So third line you cannot produce, guys. So this will result in total variable overhead variance. Like if you will take the difference of the first line and the second line, so this will result in total variable overhead variance. And here we have a very important note. The note is that if the variable overhead is applied on the basis of output, no efficiency variance arises. Please don't forget, no efficiency variance will arise. Okay, don't forget this point. This is really important. Now we are going to look if standard rate is not given. So how we can calculate the standard rate? So we can use the below two formulas. So the formula number one, if standard means a budgeted variable overhead rate is not given. So first formula is what? We will take the budgeted total variable overhead cost in dollar, and we will divide it with the budgeted total labor hours or machine hours. So this will give you standard variable overhead rate. And the second formula which you can use, it depends upon the data, how you are provided data in the question. The second formula we can use, we can take standard variable overhead rate, which is always equal to usage variance in dollar, means say efficiency variance in dollar. So you need this efficiency variance, and you will divide it with the difference between actual hours and standard hours. So this can also provide you the standard variable overhead rate. Now we are going to move to the question, and let's apply whatever we have learned in the concept. So let's apply through the help of questions just to make it more clear. We have a showdown INC estimated output for the period of 18,000 units. So this is the estimated output. However, actual output was 16,500 units. This is the actual units. Standard processing time is 1.2 machine hours. This is the budgeted time per unit. But the actual usage was 1.3 machine hours per unit. This is the actual time for each unit. The standard application rate for the variable overhead was $8 per machine hour. This is the standard rate. But the actual rate was $10 per machine hour. This is the actual rate. So how we can calculate the variable overhead variance now? So I'm going to calculate both variance. So first we will write actual hours times actual rate. Then you will second line you will write here actual hours times standard rate, and then we will write third line, which is standard hours times standard rate. So here you can see here actual hours. How you can calculate? You need actual level of output, which is 16,500 unit. It is given in the question here. Okay, you will multiply with the 1.3 hours, which is actual time. So you will get actual hours as 21,450 hours. Then same line you will paste it here also, because second line is also actual hours. And now you can calculate the third line, which is the standard hours. Standard hours we will always calculate for the actual level of output, which is 16,500 units, multiplied by budgeted time, which is 1.2 hours per unit. So this will result in 19,800 hours. And now you will multiply with the actual rate and standard rate and standard rate. So actual rate is $10 per hour. It is given in the question here. Okay, you can see here. And standard rate for each hour is $8, which is given here. So now you will just multiply actual hours with the actual rate. So you will get the answer of the first line, which is $214,500. So once you will multiply actual hours with the standard rate, which is the second line, so you will get here $171,600. And once you will multiply standard hours with the standard rate, so you will get $158,400. If you will take the difference of first two lines, the first two lines is the rate variance you can see here. And whenever your actual rate will be more than standard, this will result in unfavorable. So in short, if first line is higher and second line is lower, so this will result in unfavorable spending variance. If you will take the difference of these two, so difference is 42,900 unfavorable spending variance. But if you will take the difference of last two lines, so which is actual hours times standard rate and standard hours times standard rate. So if you will take the difference of last two line, so this will result in efficiency variance. Again, rule is what for all cost variance, if first line is higher and second is lower, so this will result in unfavorable variance. But if first line is lower and second is higher, so this will be favorable. But here the variance is unfavorable. So if you want to calculate the total variance for the variable overhead, so what we can do, guys, so just we can net the spending variance with the efficiency variance. So you will get the total variance. Or in other word, if you will take the difference of first line, which is this one, I mean to say this value, okay, which is 214,500, and the last line, which is with the answer is 158,400. So you will get the total variance. It will give you the same answer. So now let's move to the question number 2. This question is little bit tricky, and you will get another aspect how to deal with the question. So let's start. We have a budgeted units for the year ended 31st December are 200,000 units. These are the budgeted units. and each unit requires 2 standard labor hours. These are the standard labor hours for 1 unit. And total overhead was budgeted as $900,000. Don't forget he used the word here total overhead. It means it includes variable plus fixed overhead. So now we have here fixed overhead rate was estimated to be $3 per unit. This is the rate for fixed overhead, and overheads are assigned to the product on the basis of labor hours. So here actual data for the year is as follow. This is the actual information. You have an actual production in units, and you have an actual direct labor hours, which is 440,000 hours. And here you have an actual variable overhead, which is $352,000. And we also have an actual fixed overhead, which is $575,000. So what is the requirement? So you have to calculate the variable overhead spending variance. And spending variance is the difference of first two lines, if you remember. So first two lines are actual labor hours times actual variable overhead rate per labor hour. And second line is what? Actual labor hours times standard variable overhead rate per hour per labor hour. You can see here, so if you will look at the first line, once you multiply actual labor hours with the actual variable overhead rate, so this should give you actual variable overhead cost. And by the way, this cost is given straight away into the question. You can see here. So it is given here. Okay. So we will put this value here. And now we need to calculate actual labor hours, and actual labor hours also you are provided with this data. So here you can see here actual labor hours are 440,000 hours. So you will put it here. So multiply with the standard variable overhead rate. And here is the trick, because you are not provided with the standard variable overhead rate per labor hour. So now we need to work. How we can work? It is showing in the working here. You can see here, guys. So this is the working to calculate the standard variable overhead rate per labor hour. So how you can calculate? It is little bit tricky. So what we need to do first, you are provided with the total budgeted overhead data. Yes, we have here total budgeted overhead, which is $900,000. We will take this one total overhead. So from the total overhead, if I will subtract the budgeted fixed overhead, so I can reach to the budgeted variable overhead. So budgeted fixed overhead, how you can calculate? So because you are also provided with the budgeted fixed overhead rate per unit, it is given in the question, which is $3 per unit. If you will take budgeted rate multiply by budgeted units, so you will get fixed overhead. So 200,000 units times $3 per unit. So this will give you $600,000 for the budgeted fixed overhead. So if you will take total overhead minus fixed overhead, you will get budgeted variable overhead. And now if you remember the formula to calculate the standard variable overhead rate per labor hours, which I told you above, so now we can divide this budgeted variable overhead with the uh, I mean to say budgeted hours. And budgeted hours, how you can calculate? So budgeted hours, you need budgeted units, which are 200,000 units, multiplied by budgeted time per unit, which is 2 hours per unit. So this will give you 400,000 hours. So if you will take variable overhead cost, which is budgeted, divided by budgeted labor hours, so you will get the standard rate. So standard rate is $0.75. So this you will put it here. So now you will multiply actual hours time variable standard variable overhead rate. So you will get $330,000. Now you can see here, first line is higher and second line is lower, because it means your actual rate is greater than standard rate. So this is the variance, which is 22,000, and this should be unfavorable. I hope, guys, everything is clear. If you really like the video, please don't forget to subscribe to the channel. And in upcoming videos, I will talk about overhead variance for the fixed overhead. And I will also talk about the variance for sales. And we will talk about mix and yield variance for the material, and mix and yield variances for the sales as well. So see you in the next video, guys. Thank you so much. Keep watching my channel. Thanks for your support. See you in the next video. Bye bye.